Many months ago, I put a couple of videos out that discussed gold leasing and how it served as the link between the gold market, treasury rates, the oil market, and the petrodollar. The videos were titled, "When Gold and Silver Go Into Hiding," and "The Gold Must Flow." They were two of my more important videos, and I'd encourage anyone who's interested to watch them. A subscriber asked me a couple of days ago to comment on the LBMA GOFO and provide an update to my analysis. Unfortunately, the LBMA is no longer publishing GOFO statistics, but we can reconstruct them using COMEX futures prices. What I'm showing you here are the futures prices of gold and silver as of the end of the trading this past week. On the far left-hand side, we have the spot price of gold and silver, which we are most familiar with. As we move towards the right, we see the price of various futures contracts of various durations. We see the typical upward sloping curve of commodities futures reflecting the cost of storage, management, and insurance of stored commodities. If we compare the cost of a 5-year gold contract against the spot price, we can see that the futures price is $77 higher than spot, which is a 6.6% premium. This is a cost paid by the owner of the long futures contract, and we can see similar behavior in silver. Silver doesn't have contracts going out beyond 3 years, but we can see that buying a 3-year long futures contract in silver costs 57 cents per ounce more than buying at spot. This is a 3.6% cost spread over 3 years that reflects storage costs and insurance costs. We can calculate for each duration the annualized cost associated with owning a paper contract for gold and silver instead of the real physical item. All we need to do is compare the cost of the futures contract against the cost of the spot metal, adjust it for bid and ask spreads, and annualize the total percentage cost. What we get when we do this are two curves showing an annualized cost as a function of the duration of the contract. In general, it will cost us somewhere between 0.25% per year all the way up to 1.25% per year depending upon duration. Shorter duration contracts tend to come with less cost. Now, gold and silver are special commodities in that they are very compact and easy to store. This is the reason why the futures premiums are fairly low relative to spot pricing. If you look at other commodities such as nickel, copper, oil, or whatnot, you will notice that the premium paid for the future is higher on a percentage basis as it reflects the increased cost of storage. This is what makes gold and silver very special. They are very compact and durable stores of wealth. If you pick any other commodity, you will be paying high storage costs and your wealth will dwindle by several percent per year on average as you roll your contracts forward over time. Still, when it comes to gold and silver, why do people even want to own paper gold and silver instead of the real thing? Not only is there counterparty risk in being in a paper contract, but you're giving up some of your wealth to storage costs over time. For large holders of gold and silver, there is a big convenience and security factor associated with being long futures instead of storing physical metal. But the answer also lies in gold and silver's ability to be lent for a profit, or at a minimum, lent out to offset storage costs. You see, holders of large quantities of gold and silver in good delivery form know how to lend it to generate a paper profit. All they need to do is sell the metal at spot, put some of the cash down to buy a leveraged long position, and deploy the rest in what they consider to be a safe paper debt instrument that has a higher yield than the cost associated with mobilizing the metal. Let's add a curve to this plot. The current rates of U.S. Treasury as a function of duration. What we can see immediately is that the cost of mobilizing silver in the paper market is substantially higher than the yield available in U.S. Treasuries. Silver cannot currently be lent out to generate a safe profit, not like it could a decade ago when Treasury rates were north of 5%. In fact, loaning silver out will not even cover the cost of storage. Those who keep their silver in COMEX warehouses are eating the cost of storage and management simply for the sake of convenience. It's possible that some of the silver owners are participating in the silver U.S. Treasury carry trade in order to offset some of the storage costs. But there is no real profit to be had, and so we can envision that the U.S. Treasury market probably has little or no bid from silver. Gold is a slightly different case. For maturities of 1 year or greater, there is a slight motivation for gold to seek a profit in the Treasury market. The margin is a very thin one, though. Rates on U.S. Treasuries are just about high enough to cover the cost of storage of vaulted gold. So again, we can envision gold bidding for Treasuries simply as a means of offsetting the cost of storage. There is no real profit motive available, and so gold is only reluctantly bidding for paper. What is concerning is that if rates on U.S. Treasuries contract, then the Treasury market will likely lose the bid from gold altogether. I've shown you in recent videos why I think Treasury rates are probably still in a long-term downward trend. We'll have to watch and see what happens when the Treasury rate curve drops below the cost associated with mobilizing gold. When that happens, the motivation for gold to carry U.S. Treasuries will disappear. We truly live in interesting times.